And I want to welcome everyone to, again, another Tech Talk. This is obviously kind of where we bring together people from financial services, banks and credit unions, and folks from the technology sector and innovative solutions, kind of where that all intersects to hopefully for the benefit of banks and credit unions, members and customers. Today, we've got two special guests. I think a number of you certainly will know Paul, but Hsieh is the CEO and founder of Concreit. His previous role was co-founder of Route, which was, I think, a telecom business. And then Paul, for those that don't know, he's an industry expert, founder, startups, Digital Insight, Double Beam, as well as I think a few others. What we're going to talk about today is a product that Hsieh came up with, and it's a fractional real estate platform, as I understand. I saw the presentation once before. Apparently now you guys have a live implementation, so that is super exciting. And I think this is a neat time, right? Because we're starting to see a lot of interest in alternative investment classes. There's kind of a move towards self-directed investing, especially for the average person that may not have access to, they're not going to be part of a wealth management business line or anything like that. So, to be able to have access to that, I think is pretty important. And then we certainly have seen climbing real estate prices that have put really real estate out of reach for the average person. So I'm super excited to hear what Hsieh and Paul have today. And then just a reminder for folks, anyone on the line, if you're not talking, just put yourselves please on mute. If you do want to ask questions, feel free to raise your hand during it or send me a text or a chat, and we can stop to ask questions. Certainly we'll leave about probably 15 minutes or so at the end to answer questions. So with that, I'll turn it over to Paul and Hsieh.
Thanks so much, Larry. Hi, everybody. I found out that yesterday was the 115th anniversary, 9/27/08, of the Model T Ford coming off the production line, the first one to come off the line. And it reminded me because I saw Neil deGrasse Tyson talk about in 1910, so 08, the car came out. In 10, the biggest industry in the US was horses, not just horses, but every related product of horses, from horseshoes to horse buggy whips and, the tires for the all that. And by 1930, that industry was gone. And I think the point is, there's not one person on the call today that wouldn't say, well, if I was there, I would have seen that there was 15,000 orders for the Model T that first week, and there was 15 million delivered by 2027. So clearly horses were going to be replaced. But the truth is, it's not that easy. I worked at a credit union as chief financial officer for Affinity Federal Credit Union for 5 years and moved to XP Systems, which is a Fiserv company that makes core banking software. And what I learned is when you see how the sausage is made, it's not very pretty, right? You have 150 software engineers trying to deploy product. And from a credit union standpoint, where the competition is and where it's going if it's local. But things are changing really quickly. And I'm going to show you that there was a migration of wealth. Maybe, Hsieh, you could fire up the couple of slides. There was a migration of wealth years ago. And I'm going to tell you when it was, how it happened, why it happened briefly, and that it's coming again. And for everyone who says that they would have seen it and prevented it and taken advantage of it, I'll show you that it's not so easy to do, right? So next slide is actually 1997. Trillions of dollars moved out of the insured deposits into brokerage accounts. And it was good for the consumers, right? They have a great return, almost 10% annual return since the 1920s. And it was good for insurance companies, banks, not so much good for credit unions, but we'll get into that. Next slide, please. So here was the pivotal event. Of course, there was the Glass-Steagall Act that basically separated banks and brokerage. In 1954, there was the Bank Holding Company Act, which basically said banks could only do banking activity. But the big day was May 1st, 1975. They called it May Day, which is essentially opened up the world for discount brokerage. You can no longer need it to have a fixed rate. You could lower the rate for commission. Everyone saw eventually the barriers were going to break. Banks and brokers would be under one roof. So B of H basically accelerated that and filed a lawsuit that went all the way to Supreme Court trying to buy their first broker. Little side note, Charles Schwab is actually the largest single shareholder of Bank of America today, even though he started off as the getting acquired. And next slide, Sean. But what really happened was 1997. They were, before then, everyone partnered up, right? So insurance companies, credit card companies, investment banks, international banks, but there's no banks on this list. Prior to 97, other than that Supreme Court ruling, there was no banks buying brokerage houses. In the next slide, you'll see that on February 1997, Morgan Stanley made a giant acquisition. And the quote they used in the press release for that event was that they wanted to forestall a takeover by a bank. They saw 15,000 plus financial institutions all set to gobble up brokers, and they wanted to get to scale. And then the big shoe dropped in April 97 when Bankers Trust bought Alex Brown. That was the beginning of a whirlwind. So the next slide, you see that every big bank found a partner, right? You can't find a bank in America that doesn't have a full service broker dealer relationship. Next slide. So if you were a financial institution at that time, if you were a credit union especially, you missed it. Probably because of the capital structure, we couldn't do acquisitions. And in some cases, credit unions offered RIA, investment banking, in-branch services, but not what happened from 97 when E-Trade came out, which is to offer self-directed, self-help platform for doing transaction processing for brokerage services. Next slide. And a side note there, it's easy for a bank to innovate on lending, right? If it used to be a signature loan and it switches to credit card, you offer a credit card. If it used to be a second mortgage and it switched to home equity line of credit, you just offer the product. But if it switches from a FDIC or NCUSIF insured savings product like a CD, and it moves to fractional real estate like we're going to be talking about today, it's not as easy to basically switch and offer that product. So next slide. So it's happening again. That wealth migration that happened, trillions of dollars, is happening again. You could see it. Just run a report at your bank or credit union on ACH withdrawals and see how much and where that money is going. But essentially, if you have no branches, you offer self-directed, you could leverage technology like AI and robo-advising. And there's this plethora of venture capital-backed startups that are really leading the way. Next slide. One thing of note is that it's the user experience that matters, right? So if you could have a great branch experience, but what is your online experience and how are you going to attract the generation of members that want gamified, highly interactive, confetti falling from the app when you get your dividend payment that mimics the kind of adrenaline hits that they're used to getting. Next slide. And if you're a financial institution, are you going to be able to ideate, incubate, develop, recruit the engineers, the product and the UX people to do it? And I think that's where, what SRS really does phenomenally well, and Larry, appreciate the opportunity to speak here, is to help financial institutions find partners that are great at all these categories. So the topic we're going to talk about is alternative investing, which is everything from crypto to there's SongVest companies where you could buy royalty streams of recording artists. But the one that's probably the most relatable to consumers is real estate. It's outperformed the stock market in the last 25 years. Everyone understands it and knows what it is. And take the same user experience breakthroughs that all these apps have achieved to get to where they are. And that's what we found in Concreit and Hsieh and his team, where they built just a world-class app. And unlike most of the companies on this screen, they're willing to co-brand and partner with and distribute through financial institutions to reach consumers. And we've structured a licensing deal with Hsieh to be able to offer that product. Next slide. Yeah, so I guess you are going to see a lot of competition now. Banks certainly get it, especially the larger banks. They're starting to offer products like this. Neobanks for sure. I worked at Green Dot for 1 year. A lot of the founders there left to form Chime, and they've been super successful. And now you even have non-bank competitors like Apple. And next slide. I guess the real question is, what if we had a time machine, right? If we could go back and we knew the Model T was coming in 1908, or we knew that E-Trade was coming in 1997, what would we do differently? And I think I would advise credit unions, if I saw the future back then, why don't we partner with a company that has the framework, the regulatory framework, product structure, the self-help tool base, the trading engine on the back end to get low fee and low commission trading, and make a credit union affiliate partner where they generate a stream of revenue. So banks did it through acquisition, credit unions did it through RIA, in-branch, high net worth promoting, but we didn't capture the vast majority of consumers that want to get started early, started with a few $100 and get into the world of investing, whether it's fractional stock or fractional real estate. And so next slide, you'll see all the banks that have an insured deposit business. There's 2 times more than that in non-insured deposits. So banks call it assets under administration or assets under management. It's the same thing. They're winning on the total relationship with the consumer and winning on total assets, and not just fixated on raising interest rates on CDs to keep more insured deposits under the umbrella. The competition is not just from banks. Look at the names on this thing. You get the startups, the Acorns and Wealthfronts and Betterments, and then you have the Vanguard, on the list, right? Interesting. This is a year old, so Betterment already has over 700,000 customers, over 30 billion in assets under management. I mean, how many banks here have grown to $4 billion in the last year in total assets just with one product suite? And the last slide is, like I said in the beginning, it's easy to see after it's over that we missed the boat. How do we do it when it's here, right? And I think if a competitor opened up a branch across the street from your headquarters or offered a product that really hit you hard, loan product that was very competitive, I think you'd address it. But I feel like there's so many hundreds of independent startup fractional and alternative investment platforms and apps that are in there. We're just simply not able to compete. So the way to do it is to find companies like Hsieh's and offer it through financial institutions. So I'm proud that I met Hsieh, and we share similar ideas on how to build product and bring it to market. So with that, I'll turn it over to Hsieh.
Thanks, Paul. And thank you, Larry, for having us on. This is it's great to be here. Really honored to be able to just talk with people here for this meeting here and dive in a little bit and share about what we at Concreit are building today. For those of you who don't know me or haven't met me before, I'm Hsieh. I'm CEO and founder of Concreit. I'm a serial entrepreneur. The last company I built was in telecommunications, and I did that out of college. We had bootstrapped that organization. We took it to about 20 million ARR before I sold it. And that moment of selling a company was very life-changing for me, where I didn't have money before or a lot of money to be able to invest. And at that moment, I realized I have to be a good steward of my own capital. And so that's what got me very curious about what should I be doing with my money? And I started doing a lot of research, and I started talking and just spending time with people to learn more and more about money and investments and where should I put and deploy capital. And what I discovered for myself personally was that real estate became very fascinating for me because it was an asset-backed way of being able to invest into a business that was generating both income and had the potential for appreciation. And as a child, my family was always very interested in real estate investing. It was always their dream to be financially free. And I think real estate was just a recurring theme that I always heard about when I was younger. And I wanted to be able to do it, the way that I thought was appropriate for me at my age. And so I started investing. What I realized, though, as I got into real estate investing is it's actually very complicated. It's very complex. It requires a lot of capital to be able to get into it. And I wanted to build a company where I'd had the opportunity to change that. I think it's our mission today at Concreit to be able to democratize wealth. And we believe that the way to do that is to be able to empower people to invest in real estate. We have an app now. It's in all the stores. So there's a mobile app. There's for both iOS and Android. And we also have a web application. We have over 45,000 smart investors on our platform today. So we've built a world-class team that is going out there to solve this problem. I think in order to do this right, we needed to really surround ourselves with some of the smartest minds in the real estate space. And so we have an advisory set and people that are part of our management team that help advise our clients today on both real estate as it pertains to debt investments and then also equity investments and specific sleeves of equity investments. For many of you here that may have invested in real estate or on the lending side, you know that real estate can be a pretty complicated sort of investment to think through. And in order for us to really bring it out to the masses, we've been trying to figure out ways to make it more simple and more straightforward and easier to understand. So we're blessed to have people that are part of our team that have built companies like Robinhood, Chime, Roofstock, Betterment, and we're also backed by some of the best venture investors out in the world today. So Paul and I have been really sort of thinking through, how do modern members look for financial products that they're interested in? I think when I first met Paul, he asked me a question like, what are your thoughts about distributing through credit unions? And it had never really crossed my mind in the past. I think like a lot of venture backed fintechs, we think direct to consumer, particularly for investment products. And we already had a very strong thesis in terms of how people look for investments or for new opportunities. And I realized that problem set is actually really relevant to credit unions and other financial institutions today. It's that the modern members will go out there, they will go search for content to educate themselves, and it ends up leading them to investing in different platforms and trying out different services, which is it's the beauty of what we've built today in terms of an app ecosystem. But I think it's also challenging for pre-existing financial institutions to be able to really leverage that as an opportunity to grow their business. So Millennial and Gen Z member deposits are leaving, and it's interesting the way that they're purchasing today or purchasing new financial services. They typically go do their research, whether it's on Google, whether it's watching videos on YouTube, listening to different financial influencers, but they're very apt to try new things. I think my generation in particular, we've had a very challenging time building up our net worths, and I think an even more difficult time being able to afford a home. This last few years has sort of been really interesting for us, where we've been able to go purchase homes, but at the same time, it's not like we feel like we're very wealthy. In fact, many of us still feel like we're living paycheck to paycheck, and so we resort to these lessons that we're learning from others to then guide us into different systems. And these deposits end up flooding into platforms like Coinbase or Titan, Robinhood, Acorns, Republic, because they speak to us. The user experience, the language, the content, it speaks to us in terms of how do we actually engage with this to then hopefully build future wealth. So the problem that we saw was that Wall Street was set up to serve the ultra wealthy 1%, but credit union members are generally not the wealthy 1%. At Concreit, we believe in democratizing wealth, and so we believe in giving everybody a fair shot to be able to build wealth long term. As we started digging into this problem more and more, we realized that it doesn't really take someone with a PhD to see how the ultra wealthy in the world invest. And many of them invest in alternatives. When you're looking at people that have billions of dollars, you'll see that they typically have a huge component of their net worth allocated into alternatives. You can see that in ultra high net worth, high net worth. The more and more money you have, it seems like the pattern is that you start stepping into alternatives, things that are outside of the publicly traded markets. We go after a group of 144 million millennials and Gen Z. They're going to be controlling over $30 trillion of investable assets. And year after year, we see that they tend to prefer real estate investments. There's also this interesting truism that's starting to form where about 75% of us realize that we need to go beyond the public markets in order to outperform the index or to be able to really feel comfortable building our wealth long term. So as Paul mentioned before, real estate dominates the alt space. It's growing very fast. When you think about just the size of different asset classes, real estate itself has been a huge asset class in the past. It's been one of the oldest as well. That's a very tried and true asset class. Specifically in the crowdfunded real estate space, it's about a $250 billion market today, and it's growing at a 45% CAGR. So at Concreit, we want to break down all the barriers to entry. Today, you can go be your own landlord. It's really designed to be something where you're quote unquote rich, but you need to have a good amount of capital to go and buy your first home and convert it into a rental. It's very liquid. It's a high amount of risk too. If you don't have experience, it can get really daunting in terms of being able to source the right deal, manage the transaction, ultimately property manage or asset manage the whole investment. So there's just a lot of things that you need to learn. You can go invest in private real estate funds today, but again, that's designed largely for rich people or credit investors only. The minimums are generally around 10K to 100K, and then when it comes to liquidity, you are sort of defaulted into their liquidity mechanisms, which is quarterly redemptions, if any, and you really should have experience to understand what you're doing. And then at Concrete, we've designed this so that everyday people can invest. You can do any dollar amount. You can have liquidity as fast as 7 days. You don't need any experience needed. We've built a phenomenal set of an advisory team that is managing different sets of strategies on behalf of our investors. And our goal here was really to democratize the access to this asset class, so we believe anyone can invest. At Concrete, we educate our members. As I started diving into real estate myself, I learned that there's a lot of things to understand. And so for us to build, to properly be fiduciary, we also felt like it was important for us to educate our investors to really understand the concept so they can wrap their head around why we're making certain decisions on their behalf. We make real estate accessible to everyone, and the unique thing about our platform is we securitize high quality real estate investments. We take them through a SEC qualification process, and they're offered through a Regulation A+ Tier 2 offering, and that gives us the ability to sell, access to non-accredited investors with very flexible dollar amounts. And just to speak to some of the products that we have some products that operate pretty liquidly. We call it, sort of an alternative to a savings product where you may want to invest into real estate and have some of the dynamics where you can still pull your money out when you need to. And then we also have a more liquid product that we're introducing. And this is what I mentioned earlier, where we're moving pretty quickly to the point where we're hoping to be able to get this out to the public, but this is where you can actually buy shares of individual rental homes. And this gives our investors the ability to build a diversified portfolio, curate and customize it for themselves, and make a bet, for the long term, and really figure out the right horizons to invest into. This is just an example of one of the homes that we brought onto the platform early on. So we generally like to look for properties where, one, there is going to be a positive spread on the initial investment, and one that we feel like is going to be supported by population growth, by a strong market, by a strong neighborhood. We need to be able to envision ourselves living there. So this property itself was showcased to our investors as a 5 to 7 year hold. It was purchased in all cash. So we believe there's early liquidity potential in the event of a refinance in the future. It's already cash flowing. This is a core type investment where, we purchased a brand new home. Not a lot of work has to be done. There's a pre-existing builder's warranty on it, and it's in a really great location to the Atlanta core. So we also look for homes that we feel like will have a very strong rental potential in the future. The teams that we build to support our clients, we try to find the best in the world. So the group that is actually overseeing our home shares product today, they have over $13 billion of management experience. They come from a group that was early in Invitation Homes. They also are entrepreneurs themselves, and so they've built prop tech companies and sold it, and they've managed a lot of different portfolios for a lot of different institutional funds. Our platform's been relatively unique. So when I came in to build this business early on, I was actually pretty surprised at how little infrastructure there is inside of this ecosystem. My co-founder and I, in order to bring the experience that we want, to realize that we need to build our own platform around securities accounting. So this has been an absolute game changer for us. This has given us the ability to have, very quick onboarding for our clients. We've been able to also register as an investment advisor with the SEC to provide financial goals. I think one of the biggest things has been our ability to operate these private equity funds very close to the same level of frequency as what you would find with a mutual fund. And that wouldn't have been possible without technology. So that gives a lot of flexibility in terms of bringing and presenting a unique experience to our investors today. We're able to bring them gamified experience. There's integrated education. We can do personalized portfolios. We're doing recommendations. And then now we're also giving people the ability to choose either managed portfolios and strategies or individual homes based on their wants. So we have over 45,000 smart investors, and I think the the thing that really gets us here at Concrete is whenever we get feedback from our clients, we have a lot of people that this could be the first time they've ever experienced a real estate investment. And then we also have those that are a bit more, they're a bit more seasoned in the space. And so we have very, very large dollar accounts too. And the feedback we generally get is it's just so easy in terms of getting into this. It's so easy to kind of understand everything that's happening. We really value transparency. And I think a huge component of this, and part of our core thesis, is if you're going to introduce real estate investing, it's such a tangible investment for a lot of people. We always are talking and trying to figure out how do we make this feel real to those people, because they're investing digitally, they're investing remotely. And so that concept of psychological ownership is something that we kind of come back to a lot of times when we're thinking about our product. And we get great feedback right now, and I'm just proud that our team's been able to build what we have so far. We're in a large market with explosive growth, and so as Paul mentioned earlier, there's a lot happening in the alternative space. I think this was a category of investment opportunities that really felt sort of something that most RIAs or financial planners generally didn't really talk about unless you had a high enough net worth. And we're now at the spot where, there's a lot of companies offering alternatives to clients, and they're going direct to consumer. And so we found ourselves sort of looking at some of the early groups, and also finding an opportunity to innovate by taking individual alternative assets and fractionalizing it. I'll stop my screen share here. I imagine, Larry, there's probably some questions that are, happening right now. I can't see the interface, so I'm going to stop my share and go back to the teams.
Yeah, so no one put anything in the chat. We will have some questions, I'm sure. I've got a bunch of questions, and so I'll probably start with those. Super excited, especially for someone like myself. I've been in and out of real estate. It started with 2 Section 8 housing rental properties back in the day. Not the easiest way to make money, I can tell you that. But
yeah, you like property management.
Did not. Collecting once a month and hearing the excuses was pretty difficult. But so you've got a bunch of already investors. It sounds like you got 45,000 investors. You've got a direct to customer model. You've got an existing app, so I can go out there right now, get your app, and make some investments, I presume, right?
Yep, that's right.
And you said liquidity, sounds like maybe on a scale, but liquidity as fast as 7 days. How does that liquidity work? Is there a market, or are you the market? So like, is it you have a group of investors that will, like, if someone wants to cash out of their particular share, is it literally another investor that is buying that? Or are you guys going, okay, we know someone's going to buy this share, we'll buy it, put it in kind of on the side here till someone comes and picks it up?
So our first flagship product was not real estate equity focused. It was actually being able to generate income off of real estate debt. So that operates a lot like a fund right now, where it's what we call like a NAV REIT, or it's a fund that sort of has a specific price per share. And so we have a redemption clause in there that allows investors to pull their money out. We generally process that on a week-to-week basis, multiple times a week. And then when it comes to home shares and sort of long-term equity, right now, the first set of homes, we're not telling investors that there's the redemption capabilities or anything like that. And generally because these are designed to be long-term investments. And so our clients that are with us today, we have a huge mix. Some people really want to keep their money liquid. Maybe they have a large purchase. We've helped a number of our clients purchase their first home before. And so in circumstances like that, we typically recommend, hey, just keep your money on the cash flow side where you have the ability to access it. But if you don't need your money within the next few years, it probably makes sense to then figure out what's the right investment for my dollars. And so in those circumstances, we try to talk about, hey, what are your thoughts around what are your financial goals? And we learn more about the clients, and then they'll be in more of a liquid product. And those generally are held for about 5 to 7 years. We may figure out some redemption mechanism in the future, but right now that hasn't been top of demand for our clients right now, just because they have the ability to choose both products.
Well, I'm thinking about it from a credit union or community bank segment standpoint. Most of them have some relationship with the wealth management advisory firm, it's going to best off, service maybe 2% of the clientele, right? And everyone else, if you're lucky enough, you get a 401k or you're going out to Robinhood or Acorn. So I get the solution is awesome. Is the benefit to the credit union to maintain those deposits at the credit union so they're not going out? Because at the end of the day, they're still going out, but they're going to benefit from that presumably because they're going to a relationship that they've got some relationship with you guys. But certainly from a maintaining the member relationship or the customer relationship, I could see that. Are you white labeling this kind of solution for a credit union? Like, what's the benefit for a credit union or a community bank to partner with you guys? Because you guys do have a direct consumer model. What do they get out of it? Is it they maintain that relationship? It's all in-house? Are you guys doing a white label? Is it they've got a branded app? How does that work?
We're testing out a few different models right now. I think it's
Okay.
tough to really tell. I think the interesting thing right now is consumers flock to these applications for the experience, and so I think it is at times it's kind of tough for us to go, hey, if you white label it, are you really crafting the same experience? At that point, or you're trying to kind of pull it into your own product offering and your experience at a financial institution is like kind of putting together all these pieces. So we're open to it. I think we're very early on. Like as Paul mentioned, we just kind of got our first pilot credit union that we're working with right now. In that pilot, what we're doing is we're introducing some branding of the credit union to acknowledge that you're a credit union member. And then there's a clear perk. There's a clear benefit. So we're saying that there's one pricing model that we have when we go direct consumer that for credit union members, they are having that taken care of by the credit union and the relationship that we have. Long term, I think the goal is to have a rev share model that works to compensate for the AUM that is being derived by credit union members. And that is something that could look very favorable to credit unions long term.
Yeah, the customer acquisition costs for fintech, they have to raise, tens of millions of dollars to build a great product, another tens of millions to market it. So I think the trade-off is if Concreit could lower their customer acquisition costs by distributing through credit unions, will the credit unions be effective at marketing with Sean and his team giving them all the help they need, to go to market?
Yeah, I've got to believe for a certain member segment, this has got to be a really attractive product.
Yeah.
I think the way that we're viewing it, the way that like the discussions we've had with Paul and even early on in this initial pilot is there is a massive underserved segment in the credit union members. And I think the only thing, like you had mentioned earlier, how do you go from just thinking about checkings and savings and then make that leap to wealth management when you need to have 250K of discretionary dollars to invest? Like that is not a normal leap for most Americans today, right? Yeah. A lot of families are struggling with just saving $500 a month right now. In fact, we're in a really challenging time where the excess savings rate is at the lowest it's ever been, and then personal credit utilization or consumer credit utilization is at the highest it's ever been. So when we think about that here at Concreit, it's like we're here to give people access. Like that's our mission, right? In order to do that, it's like how do we be thoughtful about this so that we can allow people to build it over time? And I think the needs of the of families that are in that sort of that in between are going to look very different than individuals or families that have $250,000 ready to go.
Yeah. What's your demographics look like for your average client? So of those 45,000 that you've got, is there? I mean, if you don't mind sharing, I would be curious. I've got some. My gut tells me I think I know what they are, but I could be surprised.
So our median age in Concreit right now is 37.
Okay.
And it's a male, and we've seen a lot more adoption in coastal cities. But we've also found that we are successful with people in the Midwest and other territories as well. The dollar amounts have been interesting. So we see, from our perspective, two segments of investment behaviors. We have one, which is if you come in and you're starting with a smaller dollar balance, we see people making more frequent investments. People that have start with a larger dollar balance, we'll see it more infrequent, but then they're usually larger checks that come in or larger investments. They're more lumpy. And so the needs are a little bit different. Our platform is really flexible, so we've been able to service both. And I think for us here at Concrete, long term, what we'd like to do is make this so it feels a lot more self-serve with, robo advisory with recommendations to fully leverage technology. We utilize artificial intelligence in a lot of the different aspects of our business today to kind of squeeze out efficiencies, but we'd like to see that also, being a part of the product and how that service is being introduced to our clients as well.
You mentioned coastal cities. Do you think that's because they're more affluent, they might have more disposable income, or do you think that it's more expensive from a real estate standpoint, so they actually have less purchasing options, or a little bit of both, probably?
Yeah, I think it's a mix of everything. I think we spent a lot of time speaking with our clients, and everyone's reason is a little bit different. I think what's surprising to us is the coastal cities tend to have a higher proclivity to trying out tech apps. And then we found too that generally with these tech companies that were doing the hiring, their median salaries were a bit higher for their employees. And so therefore there was always like a little bit more discretionary funds to be able to invest. What we found in terms of loyalty, what we found in terms of people that really are finding the value investing a lot with our platform, it's pretty spread out. So, it's interesting just to think about the different dynamics of the markets they're in versus like what their behaviors might look like on our platform.
And how are you guys advertising? Like, I'm pretty sure I listen to Bloomberg Radio all the time, and I think I've heard Masterworks on there, right? Which is an alternative investment for artwork. But so what's your kind of advertising approach? Are you doing it through online? Are you doing it through partnerships? Like, where would I hear about Concrete?
We were doing a lot of direct to consumer sort of online, and then we also did some like traditional media. We did a radio campaign. We are now testing a lot more with communities, and so sort of in conjunction with working with credit unions and banks, very specific communities that are focused and have maybe an interest in real estate investing. And so our product is relatively new. The concept is relatively new. The ability to go in and fractionally purchase a home for the non-millionaires out there is going to be a relatively new concept. So we feel like in order to do that, there needs to almost be quite a bit of conversation, like this, right? The fact that we're going through, you're asking me a whole bunch of these questions. Like, I found that a lot of these conversations end up getting to the point where there's just a lot of like questions around what's the structure, what's the return rate, what's the market, what do you think you're going to do in this situation? And those are all the right questions to ask as an investor. It's not quite as straightforward as saying, hey, I'm going to go buy a few, Amazon, buy some stock of Amazon right now. It's not as simplistic as that, or going, hey, I'll go on Robinhood, or I can choose this platform, right? Like, we offer very unique opportunities, but at the same time, we offer the ability to tap into a very tried and true asset class in a way that you can't find with publicly traded REITs.
It seems like this would be something that I would see on a Reddit forum.
Another thought,
Yes. Yeah.
Larry, it's not just reaching the consumer, but there's, I remember years ago, I went to meet the co-founders of Acorns and pitched them. I was with David Dean at the time, and we pitched them on reselling, instead of direct through financial institutions. And, they wanted to go the direct route. And I think the dream of most entrepreneurs, if you could get to $1 billion market cap and get publicly traded and not have your brand, in someone else's hands, I think that's the real goal. But it's very, hard to do and very expensive. But the credit unions and the banks as well have a trusted relationship with that consumer. So a lot of these products have hidden fees, the trade execution fee. Some crypto companies are saying it's zero trade fee, but if you look into it, the bid-ask spread is astronomical, and they don't disclose who the ultimate trading partner is that does trade execution. There's monthly fees. There's acquisition cost to buy products like art and real estate that are not always easy to get your fingers on. So I think the goal, for the way I envisioned it, is assembling companies like Sean's, where the credit union could go to the member and say, hey, you trust us. We're going to do all the vetting. We're going to make sure that they're the lowest commissions, the lowest trading fees, the lowest hidden costs, the highest return to the consumer. In fact, I imagine some credit unions are going to say, we don't even want to take our affiliate fee fully. We want to reinvest it back to the member to give you a higher return. And for the bankers in the room, I apologize. I keep using credit unions. I did work for a bank and credit union, but I talk to more credit unions every day, so my lingo is met.
we have a little bit of both. Hey, I want to open up the floor to other questions. I have a tendency to monopolize the conversation. So if anyone's got a question, just please unmute and ask away.
Hey, this is Jesse McGannon. It's funny, you were going through the demographics and it literally hits me in the numbers. I'm 37, live on the West Coast. And I was just curious, how with the individual home investment, which my understanding is that's not quite live yet, but when it is live, how does the return on investment work for that? Is it that you're getting monthly dividend payouts based on the ROI of the property? Is it you're waiting until that property is eventually sold? Like what are the different sort of cash out opportunities with that share of a property?
Yeah, so we're doing quarterly payouts of dividends, and then on disposition of that property, sort of whatever the appreciation is going to be distributed pro rata to investors. Right now it's quarterly, just because this is sort of like our first year operating these. Like if you take a look at our flagship cash flow fund, we pay out weekly. So it is fully our intention to get to a higher frequency. I do believe in sort of the diligence and the discipline of being able to invest more and more and more to develop more passive income streams. And so our hope is that our investors, build portfolios of 10 to 100 homes, and they're just building all these different income streams that are paying them at different points in time. It's sort of that dividend investor mentality. You want to build a really solid schedule of cash flowing assets for yourself. And so those are the types of behaviors we like to encourage here at Concreit.
Got it. Thanks.
Other questions? It's a good question, Jesse. I've got a question. How is this treated an investment in Concreit from a tax standpoint? Are these, I think if they're basically, it would be a security, right? Is it just like a security portfolio? That's right. So you got capital
security.
Gains. Okay.
That's right. Yeah. So all of the pre-existing products that we have from a tax standpoint, we're a C corporation. We're electing as a REIT or intending to elect as REIT. And that's how we can maximize the tax benefits for our investors. Because we're dealing with so many investors, it doesn't make sense to do an LLC structure where people are partners. We thought through the dynamics, and it was interesting. It's like if people invest in, let's just say, an average of $500 per home, all of a sudden you get a K1 in a remote state. It's like the cost to then do your taxes there for your $500 investment doesn't make any sense whatsoever. So from a structure standpoint, you'll be getting a 1099 div on those dividends, and then if there is any sort of capital appreciation, then that'll be a separate form.
Appreciate it. All right. Any other questions? If someone wants to reach out to you to get either a demo, have a deeper conversation, if they're a credit union and community bank, want to see what a partnership would look like, how best should they reach out to you? Is there
you can reach out to me via email?
In?
Yeah, so let me put mine here. So Sean at Concreit, and then there's also Paul at Concreit. I think either of us work. We talk every day, so you can shoot us an email, and we're more than happy to dive into some conversations around more around how Concreit works, anything from the technology to the structure to the investments. That's what we're here for.
And if anyone loses those emails, you're always welcome to contact me. I'm happy to contact Sean and Paul.
I also put in the chat, Larry, an article we published in CEO Insight that talks about this topic. And I think
I saw that. You know what, I'd be curious. It's probably the same. Actually, I'm sure it's the same. We've done a lot of analytics around deposit outflows, and it's been pretty consistent, except that obviously asset classes change. We saw for a while there a lot of crypto and then self-directed investing. But we typically told our clients, because it's pretty consistent depending on, regardless of geographic location or seg or whatever, always seem to be about $1.5 million, $1.7 million going out the door in deposits per month for $1 billion in assets. And I was just curious if you guys have done any looking at that, because that's pretty significant. If you're $1 billion financial institution, you're losing, 20 million a year in deposits. That's a bad situation, and you're potentially losing a relationship for life, right? One that you spent a lot of money to acquire. So the more hooks you can get in the customer member, more important.
I read it's 350 billion is what's total leaving the U.S. depository banking industry each year. I just know anecdotally, when I go back to New York, my family lives there. When if someone dies in their family, there's usually $70,000 in a checking account somewhere, and when that goes to the kids, immediately goes into an investment product or pays credit card bills, right? So there's a lot more money that's going to leave based on inheritance and other factors as well. Hey, Larry, I want to mention one more thing on we basically, Sean and I have put together a program for pilots. We're looking for 2 more, and we're offering a no-cost pilot for the baseline integration and testing.
That's great.
If you're interested, shoot an email to Sean and I, and we'd love to have Progressive Financial Institution add to the pilot next. We have one in New York. We're looking to add a couple more.
That's a great offer. I'll also remind people, from a demographic standpoint, we're going to see the largest wealth transfer the world has ever experienced, right? As the baby boomers age out, nice way of saying, dying, and that wealth gets transferred down to the next generation. And Sean, to your point, they're going to invest it in something, and that younger generation isn't as comfortable with the Vanguards of the world or the Raymond James, but they are very comfortable with the Acorns of the world and hopefully the Concretes of the world. So I think you guys are onto something. Super excited to watch how it advances. I want to thank everybody who was on the call. I'll pause one more time, see if there are any questions. If not, we can wrap it up. But I want to extend the sincere end of the day thank you to Paul and Sean. You guys have been awesome. All right. Well, if it's not for anything else, no one else has any questions, we'll go ahead and wrap it up. And again, thank you very much. This was super informative, and look forward to seeing where it goes for you guys.
Thanks, Larry.
Thanks for having us on.
Take care.